This is InvestTalk. Independent thinking, shared success.
Hi, this is a great show. I just have one question regarding energy transfer stock, ET. What are the prospects of buying this stock for future? Thank you so much. I will really appreciate your input. Thank you.
All right, looking at energy transfer, and by the name, you would probably guess what it does. Which is transfer energy, mainly natural gas, throughout the United States. And with the boom in shale, obviously the supply of natural gas has gone up, and therefore the profits for energy transfer has gone up as well. So, Luke, why don't you give the listeners a little more details on the financials of ET?
Yeah, well, in terms of their balance sheet, they're about a $60 billion US dollar market cap company with about $60 billion in debt. But a lot of that debt is at pretty low interest rates. So, their interest coverage ratio is in about 2.9. Now, in terms of earnings, on May 6th, they reported earnings. Their EPS was about 37 cents per share, slightly above analyst expectations of 36. But the revenue was below the projected $22.42 billion by about $1 billion. And so what has really hit at that is exactly what you're talking about, the market dynamics within the natural gas space.
Yeah, and one thing to understand about this is it's a limited partnership. So that dividend yield, nice juicy 7.5% dividend yield, is not as exciting as most people will think, right? Because if you own that within a tax deferred account, there are tax issues if you earn over $1,000 a year there. And if you own it in a taxable account, well, it's taxed at your ordinary income tax rate. So depending on where that is, that could mean a lot or it could mean a little. So you have to certainly consider that. And, a lot of these names that are in this business, moving natural gas, oil, et cetera, they do have a leveraged balance sheet. It's a very capital intensive business. They're building out big, creating big infrastructure projects, and that can pay off in a big way because it's basically toll booths for the oil and gas industry, and that can be very lucrative. Now, with oil prices lower, though, obviously that hurts potential new supply coming on, and I think that's why you've seen last quarter revenue growth was negative 3%, profit was up 13%, but you're starting to see much slower growth, and I think that's why it's trading at a low teens multiple. From a technical perspective, it's overall as a relative strength of 50, so it's right smack dab in the middle over the past year compared to the rest of the market. And as you would expect with that relative strength number, its chart is okay. It's still in a longer term uptrend. But it's basically flat since, November of last year. You're getting that dividend, but, overall, I'd rather own a company that doesn't have the tax issues of its payout, right? So I would look for others within this industry. What do you think, Luke?
Yeah, I would agree with that. I think people too often see that shiny 7.5 number and don't dig in and realize that you should be thinking about the after-tax dividend yield that you're getting on there. And like you said, for most investors, especially the higher net worth individuals, you're going to take a big tax hit on that income you get from this name.
And do you want to have the complexities of filing another tax return because you
another hidden cost
in your 401k, in your IRA, right? It just, for most people, it doesn't really pencil out. But hey, I think for more sophisticated investors, it can make sense. But I would pass on it and find another name within the industry. Let's head out to Ohio and talk to Dave. He's looking at Cube, C-U-B-E. Do you own it or looking to buy it?
I own it, and I'm thinking about adding to my position.
Okay.
I'm kind of like semi-retired, so I'm looking at maybe producing some more income and just get your take on it. Thank you.
Okay. So this is a REIT that owns, operates, and develops self-storage facilities here in the United States, about a 4.8% dividend yield. The good news on the revenue side is that revenue accelerated from 1% growth to 4% growth last quarter. That was nice. But funds from operation, which is effectively the earnings for the REIT space, that was down to 7% last quarter. It's supposed to be down 2% this year. Overall, the self-storage space is a lucrative place to invest in the REIT space over the long term. It tends to be anyway. So what do you think about this, Luke, especially compared to maybe its competitors?
Yeah, well, one thing I do like is the amount of acquisitions they've done in the past couple years. So it looks like their business model for how they manage these is they essentially outsource these to various third parties to manage them, and they just own the land themselves. And so because of that, you have a lot of, or rather you have little overhead in terms of the management and personnel required to manage disparate properties across the US, internationally, in this case, just geographically in the US. And so that doesn't really tie you down to any region. It doesn't allow or doesn't create barriers before you do those strategic acquisitions. So that's certainly something that I do like about this company.
They move fast.
They move quickly, but at the same time, right, you're starting to see, little declines in occupancy, same store revenue year over year has dropped. Their growth strategy is great. They have a consistent dividend, but they are facing a little bit of headwinds, but so is a lot of the industry as well.
Yeah. Yeah, that does make sense. Especially when the economy is slowing down, people cut their storage expenses when they can. Maybe clean up the clutter, and I think that's why you're seeing maybe profitability and overall growth of revenue slow. And they probably are feeling the bit of pressure on labor. Right, labor costs are generally going up in the broader economy, although it tends to be a relatively low labor type of business. So that's a positive here. The question is this a better name than something like, what's the other big one? First Solar. Not First Solar. There's another storage REIT, self-storage. What am I thinking of? I don't remember off the top of my head. There's another big one. Can you think of it, Luke?
I mean, there's public storage.
Public storage. There we go. Public storage. That's the big one. So PSA would be their biggest competitor. Now, lower yield, 3.87%, but has a better history of profitability. I would have to dig in. We'd probably need a little time to compare the two. And that's what I would be looking at this against, to see if the higher yield is really worth it. Just because it has a higher yield doesn't mean it's automatically a better investment. So I would be looking at PSA as a comparison. Just a quick look here on PSA's return on equity. That's about 20% versus 13% for Cube. So if you're looking at long-term profitability, probably PSA is going to create more shareholder value over the long term. Now, there could be a difference between valuation, and that could matter, but I would definitely look into both of them and compare. Thanks for the call.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos.
Hi, Justin and Luke. I was listening to Justin's YouTube video recap this past weekend, and he did mention to take a look at some healthcare companies because he thinks that it might be starting to get attractive. Ashley did own 3 companies. Eli Lilly, I cut that one. I still own McKesson. That has done very well. I believe you guys hold that as well. The one I'm asking for is Bristol Myers Squibb, ticker BMY. I was hoping if you could take a look and let me know if you think that is a good company. It is a small portfolio. Maybe I can add some shares if you think the price is attractive at these values. Thank you very much. Have a great week. Bye.
All right. Yeah, I did on my weekly video. I am seeing some signals that the sentiment in healthcare is getting pretty bad. And when you get very bearish sentiment, that typically creates some buying opportunities. So there are names out there that I think probably deserve to be down, but others are probably being thrown out with the bathwater. And I think this caller's question is Bristol Myers one of those. Obviously down from its 52-week high, down 23%. Its 52-week high is around $63 and change. Now we're trading at $48.79 at the close today. What do you think, Luke? Is Bristol Myers one of those babies being thrown out?
I think it could potentially be, right? You saw some good news today with their collaboration with ticker BNTX BioNTech on their cancer treatments. And so I agree with you. I do tend to agree with you that too often, right? So much of a stock's performance is driven by how the sector is doing. For better or for worse, 60 to 70% of the performance is just going to be how the sector is doing. But for investors such as us, such as the callers, such as all of those listening, when companies are unfortunately dragged down with the rest of their sector, it provides those buying opportunities that you can really benefit from when cycles change and lights shine down on these bright companies that were otherwise dragged down.
Yeah, the biggest issue with Bristol Myers, the biggest worry is that revenues and earnings are expected to continue to decline through this year. First quarter, revenues are down 6%, earnings are down 3%. This quarter, analysts expect revenues to be down 7%, profits down 19%. For full year, earnings are expected to be down 8%. So that's the issue, but it's trading at, even if you go based on next year's earnings, which is supposed to be another down 12% to $6.07, that's still about an 8 times forward-looking multiple. That's pretty cheap, Luke.
It's pretty cheap.
That's pretty cheap. And as long as this can level out at a reasonable level and maybe get some growth based on that partnership with, like you said, Luke, with the BioNTech, then I think this could re-rate back into maybe the low teens. If it really relates to the low teens multiple, that's pretty good. $13 billion in current free cash flow on a $99 billion market cap. That's a pretty high free cash flow yield. Now, they do have a good amount of debt, about $37 billion in net debt, but not too egregious. The interest coverage ratio is 4. So that's pretty solid there. So I think this would be a good candidate for those names that maybe the sentiment has gotten too bearish, and you know when you have this free cash flow, price of free cash flow at 7.5 times, that means if free cash flow is steady for the next 7.5 years, it can basically buy back its entire stock, right? So you're getting a pretty good price for Bristol Myers, despite, I think, some near-term challenges. So to me, the price is right here. Now let's pivot over to our YouTube channel and tackle one of those questions. Gil Tel Aviv says, love the podcast. Thanks for the great insights. I own Apple, which is down 25% from its 52-week high, but still 15% above its low. Is now a good time to add, or should I wait for a better entry point? What are your thoughts, Luke?
Well, I don't think I have to explain to anybody what Apple is as a company. Obviously, we all hold these things in our hands, one of the products that sells very well for them. And so for us, right, in one of our strategies, we currently hold Apple, albeit at a reduced weight to what we had held it at for quite some time. But the reason being that even though this company is facing some, let's say, asymmetric disadvantages, right? It was targeted by the administration, told that it must produce all of its iPhones in the US. That, bluster, doubt that's ever going to be something that is forced upon them. But they've also had to shift a lot of their production to factories that already existed in India, right? And so if tariffs go into place, well, does it hurt their bottom line is the question. Now, my contention, and one of the reasons why we still hold it in one of our strategies, is that the elasticity of demand for iPhones is a lot stronger than what a lot of people would think. And people tend to be on this upgrade cycle continuously. And this is still one of the largest companies in the US, and the United States is still a consumer-based economy. And so when you're looking at it from the long lens, that although there may be some short-term, some medium-term turbulence, from a long perspective, it still has the products, it still has the cloud infrastructure to be a very successful company.
Of course, yeah. It's one of the, I've said for a long time that it was, of the Mag 7 names, has the best business, has the best consistency of its cash flows, and has a barrier to competition better than, I think, any of the Mag 7 names. Because, as Luke said, the market share of the iPhone is extremely high, especially here in the United States and in many parts of the world. And I think that ecosystem just locks people in. You kind of have this duopoly between Android and Apple. And Android is not, the Android business is not nearly as profitable for Google and the other handset makers that make those products as it is for Apple. They've done a very good job of keeping prices elevated, keeping those margins high, but still roping people into the ecosystem. Now, however, I would say I've downgraded Apple within the Mag 7. Now, it's definitely not the bottom, but I would put a couple other names above Apple because of the supply chain issues that are clearly a challenge. They put a lot of money into their supply chains within China and India. And I think that's going to be very difficult. It's just they can't produce it here. Now, as much as the Trump administration might want them to, as they might put enough political pressure, that's something that's just not going to happen. And so I think that's going to be at least a near-term challenge for the next few years. So that's why I would say I'd be patient on it. There's probably going to be better buying opportunities to really get into this in size. And for now, I would hold off in adding to the position. I'd probably continue to hold it, but it's not something I'm jumping at the bit to, or chomping at the bit to buy more of.
It is also, one thing that I want to add. It's an interesting case study because if you look at Apple's market share in terms of the phones, right, in terms of people's phones, it has such a dominant position. Yet the driving force of the market over the past 2 years, AI, Apple has arguably the worst AI integration at all, whatsoever, right? Microsoft's is better, ChatGPT is better, Gemini is far better ingrained in Google phones. Yet in spite of that, in spite of this thing that has been supposedly driving CapEx and driving market sentiment over the past 2 years, Apple is like last. Yet they're still in such a dominant position in the hardware market.
Yeah, it shows how strong that ecosystem is.
Exactly.
Yeah. So if they get it right, then and maybe it's just an acquisition. They have so much balance sheet capacity and cash flow to go make acquisitions on that front. And I think they'll get it right in the long term. Now let's pivot over and talk a bit about the change in correlation within the currency and bond markets. And that's in relation to U.S. government bond yields and the dollar. And historically, you've had a strong correlation between yields and the dollar. So yields go up. That is a signal that the economy is getting stronger, and therefore the US dollar would get stronger. However, as of late, the correlation between the two has fallen to the lowest level in nearly 3 years, basically since Liberation Day. Since early April, the 10-year yield has risen from 4.16 to 4.42, maybe a little bit higher today. And the dollar has dropped 4.7% over that time period. And this is starting to look a lot more like an emerging market. So what are your thoughts on that, Luke, and how that shifts the risk dynamic for foreign investors when investing in dollar assets?
Yeah, well, it certainly complicates the model of traditionally hedging while investing in US-based assets, right? So historically, like you said, you tend to see the correlation between treasuries and dollars, the reason being that a lot of people are buying dollars, but you don't just want to hold pieces of paper because it's stupid to hold just pieces of paper. So people use those pieces of paper to buy US treasuries, right? And so the demand for both tend to work in tandem. But now you're seeing kind of a hedging breakdown between where people traditionally invest in US assets and then are selling dollars now. So what does that mean for the demand, for the knock-on effect for those assets? It could be long-term not so good. Now, that being said, right, we're still seeing pretty solid demand in the treasury market from an international perspective. We haven't really seen a breakdown there. People are hinting at the dollar. I've even been talking a little bit about it, the dollar getting a little bit of erosion in terms of its role in global financial payments. Well, as of last month, you're still not really seeing that, right? You actually saw the dollar as a share move even higher as the euro continues to fall and the renminbi out of China continues to rise as well. But you can't ignore the dynamic shift and the hedges that have underpinned a lot of risk management within the market for decades.
Yeah, and that's really what it's about. It's these foreign investors are now a bit more worried that the dollar will no longer be a tailwind to the total returns, will now be a headwind, as it's been basically all year, and especially since Liberation Day. Now, in emerging market countries, what happens typically when the economy weakens, you do get higher rates and you do get a weaker currency. Why? Because if the economy weakens, the central bank lowers rates, and the long end, and that's when I say rates are up, the long end goes up because there's worries about defaults, because a lot of these emerging markets, they don't have as deep of a funding system as the U.S. government has, right? And so there's more worries about the defaults, and that's why emerging markets act that way. And that's kind of what's happening here. Now, the U.S. dollar has its integrity is built on a few things. Number one is the rule of law. Number two is the independence of a central bank. And number three is policy that is predictable. And kind of all three of those have been called into question in some way, shape, or form over the past 3 months. Now, you can argue how much that the market is offsides there, right? How much will President Trump kind of try to get around a lot of the laws and push on rulings from like the Supreme Court, et cetera? How much independence will the central bank really have? It's pretty clear that Jerome Powell is trying to keep that independence right now, but we know we're less than a year away from a new Fed chair, and that could be pushed in a direction that is less independent. And then policy. Tariff policy is very much unpredictable. And we've seen that over the last few months. So these are dynamics that I think are shifting both the Treasury and the currency markets in this way. And so it's something that all investors are having trouble with, trying to figure out how to handicap these markets. But what's clear, Luke, overall, that these risks are creating a nice, strong tailwind to gold prices. You saw that again today.
Yeah, they certainly are. You did see a pretty strong move in gold, especially early in the day today. I mean, we've all been tracking gold for the past 2 years now. It's been a historic run up in gold over the past 18 months. And the thing that is going to likely exacerbate that is the big, beautiful bill, right? If you have continued erosion in the U.S. financial debt picture, adding the low estimate of $3.3 trillion over 10 years to U.S. debt, well, that's going to further erode the power of the dollar, the strength of the dollar. Yields are going to spike up again. And then this essential haven of an asset is going to have less power within financial markets. Where do people go? They're not so much going to Bitcoin. When yields were rising and gold was rising on the back of a lot of uncertainty, Bitcoin was falling, right? You did not see it acting as digital gold. The only thing you've been seeing acting as gold is gold.
It's gold, yeah. Yeah, and silver did join the party today, so that had some, long-term gold and silver are correlated. But yeah, that's definitely the more of a safe haven. Bitcoin is kind of still holding the 100,000 level, but it's not acting like the safe haven that most people tout it to be. And certainly gold being, with its history of being a safe haven for hundreds, if not thousands of years, I think it remains in that camp. So definitely with these dynamics, gold will continue to get some tailwinds.
Join our community of savvy investors. Subscribe to the KPP Premium newsletter for expert analysis and stock ideas.
Hi, guys. This is Dan from Walnut Creek. And I had a question on the stock MP Materials Corp, stock symbol MP. And I was wondering if this is a good play on rare earth minerals. Is this like a buy and hold for a while, or should I just forget about it for right now? I haven't purchased it yet, but I was looking at it. I see Bank of America and CFRA both have buy on their sites, but they haven't been updated since 2021. So just like to get your guys' opinion on this. Thanks very much. Bye.
2021. Well, that was when it was in a strong uptrend, and it peaked out in early 2022 at around $60 per share, and it's been pretty much in a downtrend ever since. It's bounced a little bit recently, but still at $20.50. Let's lose 55 cents this year and 17 cents next year. Luke, what's interesting to me about the whole narrative around rare earth minerals is that I think people take the name, the title, too literally. They're not actually that rare. They're just hard to get. And one of the reasons why China is a strong producer of them is that they're willing to tear up the earth and go through the process of extracting them from large amounts of dirt and kind of destroy the local ecosystem to get them. So, MP Materials, they have these rare earth minerals and rights to the deposits, but it's not easy to get to. It's hard. There's a lot of regulatory issues with it, and then also, end demand is kind of waxes and wanes depending on end product demand, et cetera. So I just don't like the full umbrella of rare earth minerals. I just think it gets people too hyped up and doesn't really allow them to focus on what the true business is, which for MP Materials, it's not a very good business.
No, it's not. It's about refining minerals, and their number one supplier is Shengji Resources Holdings out of China. Obviously, given heightened trade tensions and China's restriction on rare earth minerals, the company hasn't been doing particularly well over the past 3 months on the back of that. In spite of that, it's up 31% year to date. So it's down 15% over the past 3 months. And what happened about 2 months ago? Well, they reported earnings and they missed both on revenue and on the bottom line. Stock fell 10%. It's down another 6% today as well.
Yeah. And despite last 3 quarters had pretty good revenue growth. 25% last quarter, 48% the quarter before, and 20% the quarter before that. But in all 3 quarters, they lost the same amount of money, 12 cents per share. And so let's lose 55 cents per share this year. So sure, they're selling more, but it's not a good business. The free cash flow is still negative. So to me, this is just a lot of hype. And you don't have the technicals lining up relative. Like I said, the peak was around 60, and it's been in a long downtrend ever since. Despite the bounce, it's starting to roll over once again. And then you have it losing money, taking on debt. It's just not a name that gets me all jazzed up to buy it. If they can turn it around at some point, maybe. But to me, this would be just a giant kind of geopolitical play that there is some sort of big cutoff of rare earth minerals from China. And it would have to be the rare earth minerals that MP produces, right? There's a lot of different types of rare earth minerals. So, and some are more rare than others. So I just don't see a credible investment case for this. Do you?
I mean, the reality is what? Capital's finite. Is this the place where you want to put your money, or is it better of use? Is it of better use elsewhere?
Opportunity cost.
Indeed. Yeah.
All right. Well, I think that does it. Luke, thanks for joining today. It was great. It's always
I was
nice
forced to be here. No, I'm kidding. I wanted to be here.
Well, I'll force you back next Monday. So hopefully we can line that up again. I'm Justin Klein with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And if today's show made you think about your own financial picture, your investments, taxes, retirement, and really whether it's all working together, let's talk. At my company, KPP Financial, we offer a no-cost portfolio review to help bring clarity and confidence to your financial picture. Just go to investtalk.com, click on the portfolio review button. And if you haven't been to the new InvestTalk store yet, try visiting it now at investtalkstore.com. Independent thinking, shared success. This is InvestTalk. Good night.